Welcome back to the MEIR dialogue, where we discuss the impact of the US-Iran war on insurance in the region. My name is Zaki, and today I'm joined by Moody's Mr. Mohammed Londe, Vice President, Senior Analyst, and Mr. Brandan Holmes, Vice President, Senior Credit Officer. Thanks for joining us today, gentlemen.
Thank you for having us.
Mohammed, Brandan, I understand, Moody's, you work with a lot of insurers around the region, and globally, in fact, right? So, Mohammed, maybe why don't you start by giving us a brief rundown on how the insurance market in the GCC has been affected by the US-Iran war?
Sure. Thank you. Thank you. So from our perspective, what we find is that the impact of insurers in the GCC region has been limited to the date. While the current ceasefire does support a gradual de-escalation, the situation in our view remains fluid and could develop in unexpected ways. The longer the duration of the conflict, the greater the risk of more negative impact on the insurers. So let me talk about the current scenario where we are in the current ceasefire. From an underwriting perspective, the direct claims impact is expected to be negligible.
Right.
As war risk is typically excluded from standard insurance policies in the region. Some insurers have had claims for damage on vehicles and buildings and property, but this has been minor and likely would fall under the war exclusion. And speaking to insurers where they do have exposure to these risks, we found that those insurers have good diversification and strong reinsurance protection and support around this, helping them to mitigate the risk.
Right.
If I may deliberate further, in our view, the more immediate channel of impact transmission from the conflict is through the insurers' investment portfolios.
Okay.
The disruption to oil and gas exports and tourism could weigh on the regional asset prices, particularly on real estate and equities, resulting in valuation declines. So if we see from the start of the conflict at the end of February, the GCC stock markets have fallen by as much as, at its peak, have fallen as much as 18% over these past 2 months, albeit to varying degrees. In our view, the larger, more diversified insurers are generally better positioned to absorb such shocks due to their lower exposure to these asset classes and stronger capital buffers. Whereas in contrast, smaller insurers typically have higher concentrations in real estate and equities and more limited capital buffers, making them more sort of vulnerable to the market volatility that exists. And maybe translating that to our GCC portfolio. So our portfolio of rated insurers and reinsurers in this region is more skewed towards the larger dominant market players who are often more sophisticated in their risk management. And as a result, we have not taken any conflict impact-driven rating actions.
Right. Okay.
However, as I said, this situation is fluid, and so we continue to monitor the developments closely along with our rated insurers to ascertain the credit impacts.
In Moody's perspective, do you think the stock market within the GCC is on the road to recovery, or will it still be, worrisome over the next couple of months?
Because the situation is still fluid, we have seen, as I said, lots of fluctuations. If I take the cutoff of 1 month into the conflict, at that point in time, we had seen the markets, some of the GCC markets, fall by 18%. Roll forward that now to nearly 2 months, that fluctuation or decline has reduced. We do see a recovery, but again, the situation remains volatile and fluid. So, it depends on the escalation and the duration of this conflict.
You mentioned earlier that, the impact on underwriting and claims, within the region is negligible. Mainly, war risk exclusion, and a lot of the business is written outside of the GCC region and in London. So Brandon, since you're the guy coming in with the global perspective, how has London been impacted by the US-Iran war?
I think there's a range of different insurance coverages which are potentially impacted or may respond to events here. I think the one which has been in the news a lot is marine.
Yes.
Certainly on the vessels, either trapped in the Gulf or looking to transit. There's also aviation, and then you get covers such as political violence and terrorism, which deals with sort of damage to property. Now, the starting point for a lot of these is that war is excluded from
Hmm.
coverage. And because that's the scenario now, the base policies would typically not respond. However, in a lot of cases, you can buy you can buy back the war coverage.
Yeah.
So you buy coverage for war scenarios. So there is some of that. And we understand that in some cases there would be damage which would be covered under those sort of war buybacks. I think if we just go through the lines of business and just talk about them a bit, marine. I think it was widely reported that after the conflict started, the marine insurers issued notices of cancellations on the war cover to policyholders. So mechanically, how it works is you have your marine insurance for sort of the hull and machinery, which is the actual boat. Then you have the
Hmm.
cargo. Then you have the sort of P&I or the liability cover. That excludes war,
Yeah.
but companies buy annual war policy,
Yeah.
which is normally at a nominal cost, and that covers the eventuality of war. However, what they're able to do is if a certain area is designated high risk,
Hmm.
as was the case with the Gulf and the Strait of Hormuz after the conflict started, it gives the marine insurers a right to cancel or renegotiate the terms of those policies, which was done. Our understanding is most were renegotiated
Hmm.
on perhaps more restrictive terms and higher costs. Um, so that's a way insurers have been able to manage and limit their risk there. Our understanding is that where vessels have been insured for passage through the
Hmm.
strait, it's a very dynamic decision. Insurers will be making this decision when the boat is sort of got its engines on and
Yeah.
ready, pointed at the strait, and then they would give a quote and allow sort of 48 hours of coverage
Right.
for passage. So it's quite fluid. I think one of the big risks insurers face, it's a longer term risk and it does seem to be reducing, but to the extent vessels are trapped in a
Mm.
region for 12 months, the ship owners can actually claim a total loss of the vessel.
Right.
Um, which would be a significant insured exposure. However, I think we're still a long way out from that, and also we've seen some vessels actually exiting the
Yeah.
Gulf over the last little while. So that risk is certainly reducing a bit over time. I can talk a bit about aviation if we have time
Yeah.
for
Yeah. Of
that.
course. Yeah. Of course.
Similar thing with the war risk cover. Um, our understanding is that these were not cancelled,
Hmm.
and the insurers remain on risk. The key way they protect themselves is through sort of sublimits for war. So a carrier might have, I mean, an airline might have a lot of airplanes or equipment exposed on the tarmac somewhere. If there was a significant attack which damaged a lot of them, in many cases, the insurer's liability would be limited to a fixed number of aircraft
Yeah.
as opposed to unlimited. So there is coverage, but the insurers have to take steps to manage this risk. Um, so those are sort of the two major classes. I think PVT, political violence and terrorism, where there is a war buyback there, you typically cannot cancel it. So it's a
Yeah.
12-month policy. So that's an area of exposure. Our understanding is that the take-up of that kind of insurance in the region has been fairly low
Right.
historically. Um, you know, as we know, there just
It's
wasn't
been,
a lot of
yeah.
concern around security
Yeah.
in the past. So looking ahead, we do think that once the region emerges from this, the view of risk would likely have been reset,
Yeah.
and there would be greater demand for this kind of insurance product from various corporates
Yeah.
in the region.
I mean, it's kind of the same like after every natural catastrophe, there's always an increased demand for that kind of for the related
Yeah.
product, right? But what do you think it means for insurers in the future, right? With this spike in demand, what do you think it means for their underwriting of this risk, right? Of PVT essentially, and the pricing of it as well. You know, if the region is now viewed to be at a more volatile, high risk location for political violence, the prices would go up definitely, right?
Initially, one would expect that, but it depends how the situation evolves over time. And you know, we always need to remember that insurance pricing is sort of supply and demand, so it's
Yeah.
basic economics, right? And people's memories tend to be short.
Hmm.
So if things quieten down and there's capacity looking for risk to underwrite, you would expect prices to drift back down again over time.
Moving on to the credit and investments sort of area for both you, Mohammed and you, Brendan. Do you think insurers will, especially within the region, insurers within the GCC region, do you think they'll change their investment strategy in any way as a result of this conflict?
Definitely, as part of ongoing risk management, we do expect well managed companies to make adjustments to their strategies, be it around underwriting or even investments. I mean,
Yeah.
they have been exposed to certain risks. Now, what we do expect going forward is, as part of our rated portfolio, as I mentioned, majority of those cases are already well diversified
Yeah.
exposures. What we will continue to expect is that new investments that they make would probably be more into the stable and fixed income categories, whilst they might still choose to hold on to some smaller amounts of equities and real estate, which in their view might be strategic or
Yeah.
critical investments. So whilst there may be a shift on the investment strategy, it would vary depending from company to company, both strategy to strategy.
Brendan, what about globally? Is there any kind of impact globally on the markets?
I don't think at this stage and from this event there would be significant impact. I think what we would expect to see is companies positioning, at least tactically, their portfolios for potentially higher inflation
Hmm.
environment. As higher oil prices sort of feed through the economy. And that's often what we see in response to sort of shock scenarios,
Hmm.
if you will, is sort of tactical repositioning of portfolios. The insurance sector generally have fairly high quality and relatively low risk investment portfolios, especially on the reinsurance and non-life insurance side, and their general stance is to be positioned for unexpected events. So
Yeah.
from that perspective, we wouldn't expect large changes. I think what one interesting thing we're watching is with interest rates having been quite high over the last few years,
Hmm.
a number of reinsurers and sort of non-life insurers lengthened the duration on their portfolios to sort of
Right.
capture the higher rates. And going into the rate hiking cycle, they actually had fairly short duration portfolios, and that meant that they were able to turn around those portfolios quite quickly and then lock in higher rates. Where we are now, if rates were to trend higher again, they would probably have less ability to turn their portfolios into the higher rates quickly
Yeah.
because they've already extended out their durations. So that will be interesting to see how that plays out. But no wholesale changes expected. Just a comment to add to what Mohammed said on Middle East region insurers. I think generally as we see the market consolidating over time and becoming more sophisticated, you do see a natural change in the investment portfolios um, to be less focused on concentrated equity and real
Yeah.
estate positions. So that's already happening regardless of what we're seeing now.
Well, I'm not sure whether this extends to the Middle East and London, but in Asia, a lot of insurers were looking into private equity and investing there as well as part of, again, diversification, as you mentioned. Has that kind of trend been seen elsewhere, especially in the UAE, in the GCC or in London?
I think, I mean, globally, right, we've seen private credit become a growing asset class, and we've certainly seen that on insurers' balance sheets. It's definitely more prevalent in the life insurance space where you've got long duration liabilities and you're sort of matching these illiquid or less liquid assets with the less liquid liabilities. What we've seen on the non-life side is there has been some investment in that, but it's really at the margins. Most insurers would have a small portion of their portfolio allocated to sort of alternatives.
Right.
That would obviously be oftentimes be in that category. So yeah, not a big exposure, and we've seen it in some of the companies, insurers in the Middle East region have some of those, but it's fairly small
Right.
sort of allocations. And here we're talking about sort of broadly syndicated loan CLOs or middle market loan CLOs, which we see globally a fair amount of exposure to that on the life side, but very little on the non-life side.
Moving on, well, to you mentioned oil and energy and oil prices, and the current energy crisis is affecting the world in a big way, more than it has. With the current, prices of oil being so high and the supply of energy being so shaky, a lot of countries are relooking or sort of revitalizing their renewables energy. Do you think insurers, would be shifting their investments or their focus towards renewable, sustainable energy as well? And they've always been champions of sustainability, right? They've always tried to push for renewables. Do you think there'll be a heightened push for it?
Yeah, and I think sort of globally and from reinsurers and commercial insurers' perspective, that they balance their portfolios, right? So that they need to manage the risk across the range of different lines of business. Renewables, some classes of renewables are quite a new area with limited historical loss data.
Yeah.
And the understanding is still developing. So the capacity they make available to that is by necessity more limited as they sort of learn and develop the ability to underwrite and price that effectively. So that's one thing to take into account. I think the other thing is that the insurers are there to support economic growth and to support their clients. So to the extent that capacity is needed, they do what they can to sort of make that available. We know that a lot of them have been investing a lot in developing capabilities to be able to effectively underwrite and insure renewables, and we see that continuing. I think to the extent that demand for that insurance grows, I would expect insurers to want to step up and provide that. But it's always done in a measured way, such that they can manage and probably sort of price the risk.
I think the Middle East region's trend, again, it's very similar to what Brandan has been saying. It's more the macroeconomic drive to diversify away from hydrocarbons. That's driven the exposures to renewables that insurers have. So insurers in the region, especially the specialists who are known to be covering energy sectors, they're supporting on both sides the energy of hydrocarbon as well as the country shifts into renewables.
Yeah.
They've been supporting those sort of covers as well, of course, with the help of the reinsurance markets.
As far as I understand, capacity is still, there's still a lot of it. Reinsurers have not been as impacted as much. But do you see any potential impacts on capacity for reinsurers? Any potential impacts coming down the line as this war continues to be volatile?
Look, I think reinsurers see this as an important region. There's a lot of development in the
Yeah.
region, not just tourism, but I mean a lot of industrial kind of development and investment in the region. And the reinsurers want to be there to support that. They have long-standing client relationships in the region, and we don't expect that they would want to pull back from that. Now, if the risk assessment and risk dynamic has changed, that may be reflected in pricing and perhaps the way they shape the covers, such as attachment points or deductibles, that kind of thing. And that will be seen in sort of upcoming renewals as the reinsurers digest that. But as we sit here now, there's ample capacity in the global reinsurance markets. Middle East is a diversifying risk to global peak zone property risks, and it's an important growth market with a lot of investment and development. So no, we don't see a capacity constraint, but we could certainly see some reshaping of that capacity or changing of the pricing around the margins.
If I may just touch upon the region's champion reinsurers who are located domiciled in this region, they have very similar sort of focus on the region and in the wider region in terms of providing capacity. However, maybe we'll discuss shortly about the impact of a prolonged conflict on the insurers itself, which can be more dire.
If the conflict prolongs, because the ceasefire announcement last week sounded great, but it doesn't seem to be working out as well as we hope. So if this this conflict prolongs, to be as long as the Russia-Ukraine war, God forbid, but how would reinsurers and insurers react to that? How would they have to adjust?
Yeah, no, I think you're spot on that. In our view as well, the ceasefire that's there in place remains fragile, and there is still significant re-escalation risk.
Yeah.
And so in a more prolonged and escalated conflict scenario, our view is that GCC insurers' risks would increase as well because they'll have heightened geopolitical risk and tighter macro financial conditions. In such a scenario, this would likely lead to sharper declines in asset prices, weaker investor sentiment, and more adverse macroeconomic conditions. All of these in tandem would sort of impact insurers' performance, balance sheets, and credit profiles. The prolonged disruption would also undermine, in our view, the premium growth that this region has been enjoying. In fact, the premium growth that this region, because of the diversification drive of the sovereigns, has been a key driver of the GCC insurance sector's current stable outlook. So any slowing of growth could intensify the competitive pricing pressures that already exist.
Yeah.
And it will make the insurers compete for even a smaller pool of business, which, if you add to the stresses that could come from claims inflation, or rather claims stagflation, could compress underwriting margins further. And if you combine this with pronounced asset valuation losses and declines, these factors could significantly erode capital buffers. And if it remains, if it is sustained, it will negatively affect the sector's credit outlook. But again, there's a caveat these rating risks would be most pronounced for
Mhm.
insurers with higher asset concentration risks, lower
Right, right.
capital buffers, and lower financial flexibility. That's in terms of this region.
So, in a prolonged conflict scenario, from London, what would London's perspective be of the GCC region as a market to invest in, as a insurance partner?
I think if you're talking sort of London market, Lloyd's insurers, I mean, one of their key strengths is being able to provide insurance capacity in difficult situations, right? So uh, I wouldn't see it changing the desire to engage
Right.
with the region. It's a very innovative set of players, and coverages would likely evolve. So, I wouldn't see that as a risk to availability of capacity in the region.
Okay.
Because I think even if the conflict were to be drawn out, these are still strong, dynamic economies
Yep.
with a lot of insurable risk and business there already.
Right.
So I think insurers would adapt to be able to continue serving the market.
So I guess my last bit, I think, is once again during the conflict, right, the first month or so, with sort of Iran and US just announcing targets, right, and openly on the media, it was revealed that there's the strategic nature of certain tech companies, US tech companies, right, those who had bases, headquarters or data centers within the GCC, these US partners, they were the strategic risk of these locations were sort of highlighted during this conflict. Do you foresee any changes in how these tech companies would treat the region and how insurers would treat these facilities?
If you think about data centers, for example, regardless of the conflict, insurers would always be thinking about the level of concentrated exposure they have to one particular property. And I would imagine that whatever insurance coverages were in place for those, and we don't have detail on that, but just knowing how the insurers tend to operate, they would have made sure to limit their risks to those properties to something that they felt comfortable with. So we think that would continue. The view on the risk might change, but the discipline of managing limits and exposures, is something that insurers always do
Yeah.
and would continue.
So gentlemen, I think that was it. That was all I had for you. Thank you so much for joining us today. Do you have anything to bring up that I might have missed that we did not talk about?
No, I think the discussion has been quite comprehensive from my side, and thank you for having me.
I think we covered a lot of ground, so thank you.
Thank you, Mohammed. Thank you, Brandan. Thank you, everybody, for joining us today on the MEIR Dialogue, and we'll see you again next week. Bye-bye.